The Big Reset by Willem Middelkoop examines the history and implications of the gold standard, the fiat money system, currency wars, and the effects of central banks printing money. This book explores how gold has been used to stabilize fiat money systems, the secret war on gold fought by the US, and how the worldwide financial system is heading for a major reset. Middelkoop draws on evidence from history, economics textbooks, and more to share his unique perspective on the current global financial system. In this exclusive video series on this channel, we will walk through each chapter of this book. Let's go! Welcome back to Geopolitics and Money, your home for the freshest updates on geopolitics, finances, commodities, and investing. Our channel is dedicated to keeping you informed on the most important trends in the world of investment and commodity markets. With our guidance, you can be sure to stay ahead of the curve and take advantage of the latest opportunities. Subscribe now and hit the bell button to get instant notifications every time we publish a new video. Let's begin with the opening page of the book, which contains a great quote from Alan Greenspan, the former chairman of the Federal Reserve. Here it is. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value. If there were, the government would have to make its holding illegal, as was done in the case of gold. If everyone decided, for example, to convert all his bank deposits to silver or copper or any other good, and therefore declined to accept checks as payments for goods, bank deposits would lose their purchasing power and government-created bank credit would be worthless as a claim on goods. The financial policy of the welfare state requires that there be no way for the owners of wealth to protect themselves. This is the shabby secret of the welfare status's tirades against gold. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. It stands as a protector of property rights. If one grasps this, one has no difficulty in understanding the statist antagonism toward the gold standard. What he's saying is that gold stands as a protector of property rights against the confiscation of wealth through deficit spending. And that's a very important aspect to keep in mind when reading this book. Alright, let's continue with the first chapter of this book, titled The History of Money. It starts with the development of money from its earliest form of bartering. Different societies have adopted different forms of money, such as cattle, dried meat, cigarettes, oil, and gold to trade goods. Gold and silver have been used as a means of exchange for thousands of years due to their special characteristics and desirability. They are also a perfect store of value, as evidenced by a 2,000-year-old Roman coin. Gold and silver are the most suitable elements for a means of payment, as their demand is infinite and eternal. Julius Caesar, Augustus, and Alexander the Great all built their empires around a monetary system based on gold. But when the Roman currency was debased, an economic crisis ensued. Following the collapse of the Roman Empire, Western Europe resorted to a barter-based economy until the Middle Ages, when the Byzantine gold solidus coin became the predominant method of payment. In the 13th century, the florin and ducat gold coins gained popularity throughout Europe, creating a gold standard. However, the discovery of vast silver deposits in Latin America in the 16th century led to a silver standard. This continued until the early 19th century, when silver shifted eastward, causing the decline of many silver standards due to wars and trade deficits. Under the gold standard, the economy was limited by the fixed exchange rate, which politicians and bankers had little control over. During wartime, governments resorted to printing more money to finance the war effort, leading to a credit bubble and ultimately the market crash of 1929, causing a global economic crisis. In contrast, modern financial systems rely on fiat or fiduciary money, which is not backed by any tangible assets like gold or silver. As a result, banks can create near unlimited amounts of money by generating new loans. The value of fiat money is dependent on people's trust in its ability to purchase goods or services. However, history has shown that all known fiat money systems have eventually failed, despite central bankers' claims to the contrary. The notion that printing more money will lead to prosperity is a misconception, as evidenced by Africa's continued poverty and the Weimar Republic's dissolution. Fractional banking started in the Middle Ages, when Italian goldsmiths began issuing bills of exchange as a form of currency backed by gold stored in their vaults. Banks eventually realized that the gold stored in their vaults was rarely being withdrawn, so they began issuing more of these receipts than could be backed by the gold. This is considered to be the origin of banknotes. Nowadays, banks hold currency or deposits with the central bank as their reserves. The central bank can then loan money to commercial banks based on their assets. This new loan creates money out of thin air, with the commercial bank then able to use this to finance new loans or investments. Through this process, a small amount of money from the central bank can generate much more in extra credit. This is known as fractional banking, and in 1900, this reserve requirement was around 30%, but has since dropped to just 3%. Quantitative easing, or QE in short, is an unconventional monetary policy used by central banks in order to stimulate the economy when standard policies have become ineffective. QE involves a central bank buying specified amounts of financial assets from commercial banks and other private institutions, increasing the monetary base. This is distinguished from the more usual policy of buying or selling government bonds to keep market interest rates at a specified target value. QE provides commercial banks with excess liquidity to promote private lending. It is often used when governments need to finance large budget deficits, as it enables them to do so without needing to find real people to buy the debt. Hyperinflation is one of the worst things that can happen to an economy, which occurs when prices rise by over 50% within a year, leading to the loss of money's value and power. It happened in Germany's Weimar Republic in the 1920s due to enormous financial pressure caused by high reparations imposed after World War I. The only way to pay them was to print vast amounts of fiat money, which led to high inflation and people losing trust in their currency. In just 3 years, the German currency became worthless, causing a financial nightmare and many Germans to lose their savings and hope, with some even committing suicide. Official inflation figures are frequently criticized for being manipulated by governments, with analysts and commentators questioning their reliability. Bill Gross, founder of PIMCO, the world's largest bond asset management company, has called the published inflation figures a con job, citing the arbitrary choice of what goes into the basket of goods and the exclusion of local taxes from the Consumer Price Index. Inflation figures have been subject to various changes and adjustments that have led to their understatement, resulting in a decline in the real value of Social Security payouts. Central banks, which claim to combat inflation, are accused of creating it by increasing the amount of money in circulation each year. They stimulate the economy by injecting new money into the system, but this can have a negative impact on spending power. In the past century, Western currencies have lost over 95% of their spending power due to excessive debt growth. Central banks also act as the lender of last resort, creating over $1 trillion in new money each year to support their governments while still claiming to fight inflation. Governments and banks have formed a partnership to control the creation of money while keeping the fact that money is not backed by any tangible assets hidden from the public. A small portion of money in circulation is in the form of printed or minted currency, with the rest being digital. Banks emphasize the reliability of money and downplay the role of gold as a safe haven asset. Bank deposits are legally debt claims, and there is a risk of not receiving immediate repayment in the event of a bank bankruptcy, prompting governments to guarantee the savings of each citizen up to a certain amount. American propaganda has misled many European bankers to undervalue gold, resulting in the closure of gold counters in some banks in the Netherlands, whereas Switzerland still sells gold and silver at most banks. Subscribe to our channel now to unlock the secrets to a better understanding of the world and how money shapes it. Our expert insights and analysis will give you a fresh perspective and keep you informed on the latest developments. Don't miss out on the opportunity to enhance your knowledge and stay ahead of the curve. Click the subscribe button now. Thank you for watching, and until next time, take care.